Welcome to the Midas Property School online presentation, designed to give you freedom through property. Behind this presentation is a do-it-all-for-you investment service, which Midas put together for clients who wanted to get involved in property but weren't quite sure how to get started. We encourage you to go right through to the end of the presentation, where we will send you our free investment report detailing our 5 hotspots for investment currently, and it will also contain some real deals that we offer to our clients. So do enjoy the presentation and do stay right to the end. The creator of Midas is Ian Clark, who's a professional investor, lives in Devon, and is a husband and father. Ian's first success was a director of Exeter City Football Club, and shortly afterwards he started an estate agency business called Clark & Co. This grew to 4 branches in the southwest of England, and he became so popular and attracted the attention of ITV, the TV channel, who started a TV series called The Estate Agents, which was a fly-on-the-wall documentary. It became so popular it drew in 10.5 million viewers. Ian's successes drew in all the trappings of what we would call a success, so he had a Ferrari and a nice house, but something wasn't right. At the height of Ian's success, his mother died aged 59, which caused him to reflect on his life. He realised he'd reached a fork in the road and had to change his idea about how he was going to spend his time. He realised that time was running out and it was so precious. He'd had enough of working 60 hours a week, looking after 40 staff, spending 6 or even 7 days devoted to his business, whereas he'd rather have time with his family, his precious loved ones, and get his life back. And that's exactly what Ian did. Ian decided it was time to make his money work for him and not him work for his money. So he decided it was time to sell. He sold the business, got a divorce, and with the settlements and everything sold up, he invested 86,000 in the property market, and he bought it locally in Bristol in the southwest of England. He turned that into 1.5 million in 5 years. But the beauty of all of this was he got his life back. He had time to enjoy his family, his friends, and his loved ones. Over the years, Ian built up a team of experts around him to help him build his own portfolio. But he would often get asked by friends and family, "Can you help me too?" And that's exactly what happened. Ian used to help people who were connected to him grow a wealth in property and get their own lives back. The idea for Property School came about when Ian attended a cookery school hosted in Padstow in Cornwall by the famous TV chef Rick Stein. The idea was you came and you enjoyed the experience of cooking, shown how to do it by the expert. And then Midas Property School was born. The first one was held in Bristol, 90 people attended, and has since gone on to be in 12 different locations across the UK. Mark Regan MBE, ex-World Cup winning rugby player, has also become a client and also co-director. Mark has recommended us to Bristol and also international rugby players who will all recommend what we do. The path to wealth is often really confusing with many different options and lots of pitfalls. After watching this presentation, your road to success will be straight. You'll also be making lots of this and then getting plenty of this back. A mentor once told me when I was developing my success formula that in order to achieve all those things I wanted, I first had to set out and decide exactly what I wanted. Then I had to find my reason why, and why I had to have it. Then, after doing that as my foundation, I had to find the right vehicle to help me achieve my goals. Then I had to plan to use it properly and keep doing that consistently from that point on until I'd hit my goal. And that was the success formula. Let me ask you the question, who is in control of your life, the media or you? With regards to property, let's have a look at this. The Daily Express says 20% house rises. And then the following week, the Financial Times says economy fears rise as house prices dip. So who's in control, the press or you? The famous wealth guru Robert Kiyosaki has written many books and explained exactly how to build wealth. He would explain that you have to get your money working for you and not you working for your money. And by contrast, he would illustrate that there are the wealth challenged of this world who start out in a job or a business and then spend 40 years running around this hamster wheel, signing up to this plan where you spend your entire life exchanging time for money. How's it working out for you? So what are the current financial choices? You could look at final salary or state pension schemes to help you out, but I'm not so sure state pension schemes will actually support anyone in the next 20 years. Final salary schemes were the good ones, but they've been phased out. This is made worse by baby boomer generations all reaching retirement in the next 10 years. This huge population bubble is going to put extra burden on the financial coffers of the state. Let's just take a look at some of the key institutions that provide with-profits pensions and see how they're performing. These figures published in 2012 showed some massive losses in pension funds. And how is yours getting on? So what do the Wealth Intelligent do? First of all, in their business, they invest in themselves. Any spare money, they invest in their financial intelligence. And with that intelligence, they learn how to buy income-producing assets, which they will spend the income on for the growth of their business and themselves. And the greater their knowledge, the greater their income-producing assets, the more wealth they create, which eventually will create the freedom that we all desire. Even the most successful people in life need a mentor. You might recognize Anthony Robbins or Jim Rohn, and both these people advise you to surround yourself with people who will encourage you and inspire you where you want to go. So we would ask you the question, who are you surrounding yourself with, and are they helping you achieve your goals? So what is the government doing about the situation? Well, they went to the Bank of England for funding, and the Bank of England obliged and printed lots of money. In fact, the national debt currently sits at over £1 trillion. The annual budget deficit is £150 billion. And all this is doing is watering down the currency, reducing the purchasing power of the pound, which is inflating the cost of goods around us. So things like food, fuel and energy prices are all rising. I'm sure you don't need me to tell you that. And those prices are hidden away in consumer price index. They're just not reflected in that index. And it's an unrealistic figure you're given by the press and the government because it's actually way over the 4 or the 5% they quote you. So what's that doing to your savings? Well, it's chewing it up. Inflation is chewing up all the value you would otherwise get from a small interest rate on your savings. And if you're not getting more than 5 or 6%, you're probably actually going backwards. Well, all this inflation actually boosts the price of commodities, and commodities are what goes into the materials that make property. So property is actually standing pretty when it comes to inflationary conditions for investors. The equity price rises, and in long-term situation, the proportional value of your debt is reduced. So it's actually not a bad thing to hold buy-to-let mortgage debt because it's proportionally reduced over time, and the asset price rises, which gives you more equity. Very beneficial to investors. So let's look at a typical example of an investment. This one's going to be a stock or a bond or something like that, where we choose to spend £50,000 on our investment and watch it grow by 8% per year for 20 years. The end position is 466%, which is pretty good, wouldn't you agree? Giving us a return of £233,048. Pretty good. Now let's choose to spend some money. So let's say in year 9 we choose to spend £20,000 of our investment, and let's just see what happens at the end of 20 years. Well, actually we lose £63,500, that's a whole 27% is gone forever, meaning our return is only £169,152. That's a pretty big dint in the end position, wouldn't you agree? Now let's compare and contrast £50,000 invested in property. So this investment would buy us a property, let's say, worth £150,000, because all we need to do is find the deposit. And let's show this growing by 8% just so we can compare and contrast for 20 years. The end position is 1,098%, or £549,144 equity is now ours because of the property value going up. This is called leverage. It's much better than a stock or a bond because we're buying an asset worth 3 times the value of our property. Now let's go back and consider spending like we did with the previous one, but this time with a property. So we're going to remortgage the property, draw down £20,000 and see what happens. After 20 years, the value of the property is still 699 as it was before, but the value of the equity is only dropped by 20,000. And you can see the end position has only gone down by 2%. Now why is that? Well, it's because the value of the property continues to go up with or without our money. And the equity position goes down by just what we took out. So let's consider, instead of taking £20,000 out, how much better would it be if we could take £50,000 out? Because that's our whole initial investment. Would you agree that property has now cost you nothing? And how good would it be if you could repeat this process and buy more than one asset rising in value? Now, I know property doesn't go up in straight lines, but I hope this has gone to show you that with leverage and with property, you can actually grow a much bigger investment than you could with a stock or a bond. Let's look at the UK housing market over the last 60 years. This is an average price trend issued by the Nationwide Building Society. You can see that the trend is your friend here, is rising steadily, and this is because of land prices and inflation. But it's also because the law lords protect landowners. The House of Lords are all big property owners themselves, so they're never actually going to penalise themselves. We also ask you to think about the law currently supports borrowing to invest in property. Could you ever see people and banks lending money to people to invest in the stock market? I kind of think not. So let's just think that the property market is protected by legislation and the banks know that it's a safe investment. Otherwise they wouldn't lend. Think back and ask the question, how much did you pay for your first house? And what's it worth today? If you took away the difference, could you have saved this money any other way? One of the most common questions we get asked is, when is the right time to buy? The population growth forecast is due to grow to 71.6 million by 2033, which puts a huge demand on the supply side of our property market. We're currently underbuilt by 500,000 properties nationwide. The rented sector provides to 4.3 million houses, and that figure is expected to grow by 20% in the next 5 years. We also have really low interest rates, which makes borrowing the cheapest it's been for a long time. And we have very motivated vendors, making it a buyer's market and therefore the best prices. We also have highest rents we've had for a long time. The Sunday Times did an article recently saying 8 into 1 won't go, meaning there were 8 applicants on average for every tenancy. In fact, people were gazumping each other by raising the rent offers to get the property secured. Let's look at a 5-year plan for one property. We invest £50,000 and look at the equity growth over 5 years. So here's our £50,000 investment, buying a £200,000 property, getting 8% return. The value after 5 years would be £293,865, giving us an equity of £93,865. That's a full 187% return. Now let's look at a 10-year plan for one property. So again, we have a £50,000 investment, buying a £200,000 property, growing over 10 years by 8%. The property value will rise to £431,785, giving us an equity of £231,785, which is a 463% return. Now let's show what happens when you reinvest the capital and grow a portfolio over 10 years. So we start out with 50,000, we wait for 10 years, we achieve 8% per year, and this time we negotiate some discount on each property of 15%. Every 2 years we'll buy another property with the capital achieved. Here's the difference. 6 properties can be purchased over that 10-year period, achieving a capital growth and equity in your possession of £666,158. And that equates to 1,332% return. How about that for an investment? Once you get to your final goal, here are some examples of what you might want to do. You could start paying the mortgages down and become mortgage free. You could live off the rental and just stop at the given number of properties. Or you could carry on and grow a bigger portfolio. Finally, you could sell the whole lot for a lump sum with tax advice. Here's a real example. Cornwall Property Investment in Ann Arbour in Dewporth. This is a market price of £160,000, negotiated discount price of £134,995, generating an equity immediately of £25,005. The rental figures are there. The deposit required is £33,750, mortgage payment of £422, management costs monthly of £110. So the monthly income on the rental is £93, but the value projected with the 8% growth is £355,592. The important thing to remember here is you make your money when you buy. Let's have a look at another example. This is a let road in Stratford, right by the Olympic Stadium. The market price was £235. The negotiated discount price was £199,750, generating an immediate equity of £35,250. The rent was exceptional at £1,300 a month. Deposit required was £49,940. The mortgage monthly payment £998. The management fee £196. So the monthly income was £106. So the value generated in 10 years was projected at £417,338. So here are the 6 steps to succeed in property investment. Number 1 is choose the right location. 2 is find the right property. 3, negotiate the discount. 4, arrange the finance. 5, market the property. And 6, review and track the progress as you go along. So let's look at location. This is an equity heat map of the UK showing in colour-coded terms how much we own in our own homes as equity. The dark blue here represents 70% and up. These figures, incidentally, were published by Savills and published in the Sunday Times. The 60 to 70 band is shown in the light blue area, and the other areas, as the lower you go, changes colour from orange through to red. We like the dark blue areas and the light blue areas, so that's Newquay, Plymouth, Exeter, Bristol, Cheltenham, the Cotswolds, London, Brighton, Oxfordshire, as an example. And this helps us explain that the UK is a very different animal. Wherever you go, there are micro-economies growing, and it's very important to identify the growth story that you can buy into and get maximum growth on your portfolio. This is a risk map published by Experian, the credit ratings agency, and it's designed to show you how risky is an area based on the likelihood of defaults on credit cards, loans and mortgages. And as you can see, the light areas are the preferred areas, and this is where your tenants are going to come from, so you want them to be good paying areas to invest in. Choosing the right location has a few key things to consider. Are you near a key transport link like a motorway or a rail link? Are you close to schools and universities to bring extra demand for families and students? Are you close to the water? Beside a river, a dock, a lake or a seaside means that you are prime location, so you can't build any closer to the water. Therefore, selecting properties on the water is often a good way to get the maximum return for your money. Make sure there are no eyesores nearby, so go and visit the site. You must see the site. You must know what's coming up too, so we recommend going on the local planning permission sites to see what's coming up in terms of planning. Go to the local restaurants, pubs and cafes during the daytime and the night time. Talk to the locals, ask them what the schools are like, ask them what it's like to live here. Ask in particular about the local development, how much is going to impact the area and what their views are. You'll get an awful lot of information from talking to them. Where is the local housing association? The last thing you want is bad quality tenants thereby kicking off, spoiling your experience for your tenants and therefore destroying your income and your rental income. You need to know if you're going to a new build property how many units there are in a block, because if there are 14 or more, that is when housing association tenants are allowed to enter, and again we don't want that impacting your rental income. Here are some real examples of properties we've sourced in the past. This is in Newquay. There are 247 flights a week to Newquay. Jamie Oliver's restaurant's there, Rick Steiner's restaurant is nearby in Padstow, and you have a huge demand from the surfers who want to go there 24/7, 365 days a year. This is also appealing for people who want a dual lifestyle. People can work Mondays and Fridays near their home, they're in Newquay, and then commute into the city centre in London by train or catching the flight from Newquay quite easily from Tuesday to Thursday. So this makes a very appealing investment. These particular properties started at 250 on the bottom, rising to 750 for the penthouse at the top. And over here on Watergate Bay, these are a 350 for a 3-bed apartments. Again, these are right on the waterfront, so they're prime location. These are Fistral Beach properties called Frederick Mews, and they currently have £20,000 off. They go to the investor, negotiated at 180, and in peak times we can get £1,000 a week rental. These are kitted out with surf racks and dry rooms for the surfers, and as you can see, it's a stone's throw from Fistral Beach, a really popular resort in Newquay. Here are some prices. The home.co.uk website, when we were buying in this area, quoted a 10-year growth of 215%. These were for flats, and then a 1-year graph of 16% for flats in Newquay. Now these are just the averages, and we mentioned 8% previously on our background research graphs, so we know we can do much better than 8%, especially when you're buying into that growth story with a discount on the waterfront. Another great location for 2012 was Lewisham, where the Gateway project of 250 million was investing in the area. That was rationalising the transport hub, creating a new riverside walk, the town centre, and creating lots of retail and commercial space in the town centre. Lewisham White Cube is sold out, but we have Lewisham Parkview going to investors at 199,950, and we love the area because of this growth story. Here are the figures for Lewisham: 13% for 2 beds between December 2010 and 11, and that's before the growth story we bought into. This property location is in Wapping, and this particular development was an old schoolhouse converted, brought up to a high spec, and then rented out at 2 and 3 bed apartments. They were 8 minutes walk from Canary Wharf, and really close to a lovely marina with yachts, restaurants and bars. So very appealing and a great location, perfect for investment. The growth forecast, or the growth trend in the area for the year we were investing, was 16% for 1 year. And here's a current investment. This is Hayes High Point Village, really close to Paddington Station, 17 minutes, 6 minutes from Heathrow Airport. We love the investment because they start cheaply for a 1-bed studio at 145. The apartments come with a concierge service, security desk, gym, jacuzzi, solarium, and spa bar. They also come really close to the main lines into the city. Hayes itself has got this kind of investment going into it. I won't read out all the figures, but perhaps you can look down to the key one, which is the Crossrail project, starts in 2018, coming right through Hayes. So we know this is a fabulous growth story, which is really appealing for investment, and there are some available today. Here's an example of a property is now sold out, right next to the Olympic Stadium. You can see there in the distance. This was the rooftop for Let Road in Stratford, and we sold 13 to investors, very close to Westfield Shopping Centre, which generated 30,000 new jobs in the area. It's really close to the European Rail Tunnel, 6 stops to Canary Wharf, and as you know, buying into the Olympic story was a win-win for everybody. They rented at £1,300 a month for a 1-bed, and we were securing £35,000 discounts for those investments. Now here's a 1-year graph for Stratford showing 24% growth in 1 year, just whilst we were buying. Let me share a secret with you on how to negotiate a best deal. The first thing to do is talk to the developers at the right time. At the beginning, they are interested in securing funding with a bank. At the end of the build phase, they're interested in moving on onto their next project and securing the profits from their build. So these are the best times when they're most motivated and most likely to give you a discount. Ask them how many of you sold to other investors. You don't want this number to go up too high. If it's up above, say, 15, then you're talking maximum competition for when you'll go to completion and you're trying to rent the property. You don't want to be competing with all the other investors. You next want to ask them for a surveyor's report or a RICS evaluation report. RICS stands for Royal Institute of Chartered Surveyors, and this should show you the price evaluation from an independent expert. So you're looking to match this with the price you're given by the developer to check it's correct. Also ask for a comparable. That's evidence of Joe Public paying for the property or a property on the block, so you can see good evidence that will match up with the price you're given, again checking it's correct. Tell the developer you can go to exchange in 4 weeks and that your finance is in place. This is far preferable to what Joe Public is likely to do. Quite often they'll wriggle off the hook after 12 weeks due to a leaky tap or something really trivial. This will really frustrate the developer, so when you're telling them you can go to exchange in 4 weeks and your finance is in place, they're going to be very motivated. Next, we're going to cover off how to arrange finance. The first thing to know is go to a mortgage broker and stay with them. This is because they understand your goals, and unlike a bank, they'll be tied to their own products and can only offer you deals tied up by the bank. This may not serve your purpose, and they may not be the best deals for you. Unlike a mortgage broker who can go to the whole of market, he will succeed with your application and he'll make sure that you're on track and will review with you constantly. This is really important for making sure you don't make mistakes, you're maximising your income and you're getting the best deal at all times. Now, you may be tempted to keep all your facts and figures to yourself and do your own research and just not want to share them with anybody. But we really assure you, trust a mortgage broker, an independent one, because they'll have your interests at heart and they'll want to succeed. Here's some basics. A 15% deposit is required for an existing build property to secure a buy-to-let mortgage, and a 25% deposit these days is about right for a new build property deposit on a mortgage. It's also worth knowing it's the rent, not your salary, that determines the size of the mortgage, and as a rule of thumb, if you want to borrow £100,000, you're going to need a rental income of £495 per month to support that borrowing. Lenders are lending these days, but they're just being more careful who they lend to, so you have to be also careful who you borrow from. The number of buy-to-let mortgages has at least doubled since 2008, and here are a few hints and tips about trying to do it yourself. Going on comparison sites is one thing, but they are paying referral fees to those that are advertising there, and it's very easy to be attracted by a headline rate and then not realise you're being declined because of the small print. That is, the criteria they're applying for this product you may not be aware of. So be careful of that, because that will impact your credit rating. In fact, you might go for a mobile phone contract and realise you're getting declined because 3 or 4 high street lenders have declined you when you were applying for your mortgages online. So just be careful. The lenders usually want the following things: a letting agent to demonstrate the rental that's potential. They'll also want a proper short-term tenancy agreement, not something that you just apply for and just download online. These often are not worded correctly for the lenders, so do be careful. You'll need some landlord's insurance, and then finally the accountant who will position you for your tax return. It's so important. The biggest destroyer of wealth is tax, and positioning yourself correctly with a taxman is vital. So make sure you're aware that your rental profit is taxable, and also the sale of your property attracts capital gains tax. So do get involved with an accountant to protect your tax. So what are the pitfalls of property investment? Well, mortgage rates could rise, and that's going to impact your rental profit. You may have a gap in the rents, and therefore a drop in your income. You may need to repair properties, and you may need to drop your rent if it becomes competitive in the area, and you need to stay competitive. So with any investment, you need to incorporate a buffer, which is the solution to all of these problems. What is a buffer? Well, it's a safety net, or a nest egg. So let's say you had a certain amount to invest, you could allocate a given amount as a buffer to protect you in times of trouble. And the bigger the portfolio, the bigger the buffer. Where does a buffer come from, you might ask? Well, when you're securing your lending, you should set aside a certain amount to keep aside and accessible for these reasons. You might want to make it a drawdown facility on your mortgage, or you can incorporate a high interest savings account as a way of accessing the money. So now we've bought our property, we need to find a tenant and find it quickly. Here's how we do it. We email 20 or 30 agents in the area, we ask them for a rental figure, And for those that come back quickly, and we like the sound of over the phone, they're professional, we instruct about half a dozen with a key to find the tenant only. We'll tell them about each other to encourage competition, and we'll negotiate the finder's fee down on that basis. So we'll give them promise of more and negotiate the fee down. Once the property goes on the market, because of this increased competition and absolutely blitzing the area with agents, we'll find a tenant really quickly. Once the tenant's found, then we take over the management thereafter. Here's how to avoid dead periods. We never allow a contract to expire in a dead time, and what do we mean by that? Well, in June and July, we don't sign 6-month tenancy agreements, because otherwise they'll become available in December and January, around the Christmas period, where it's next to impossible to find a tenant. So the thing to do is to sign an 8, 10 or 12-month agreement in June and July. The next thing we do is sign tenants on a 2-month notice period agreement, which gives us more time to market the property, and we also do a rent review prior to that time. So we're serving notice to the existing tenant if they won't pay, and we're also giving maximum time to get the incoming tenant on the right market rent. This moves the rent up with a minimum amount of fuss and causes the minimum amount of void and gap periods. The final thing we don't do is we don't charge landlords a re-sign fee for signing the existing tenants, for another 6 months. We think that's disgraceful, and other agents do it, but we don't do it. Now, because we're managing centrally, we become a single point of contact for our landlords. Therefore, we have clients in Hong Kong, for instance, with 12 properties dotted around the country, but giving them a single point of contact, which is really easy for them. That means they don't have to remember the names and phone numbers of all the different agents. They don't have to deal with lots of different people. They have a single code of conduct, a single fee structure, and it makes life so much easier. But it also allows the investor to diversify their portfolio, buying into growth stories as and when they arise. We also cover a nationwide maintenance service for emergency numbers for landlords and tenants. And then we have this amazing cloud-based computer system which allows landlords to click on a button at the end of the year and download their accounts. Much easier for landlords. So what's the lowest entry point for investing with Midas? This property is worth £125,000 as a purchase with discount, and the investment required is £30,000. Here's a very unique investment which gives maximum return. It's a David Wilson show home leaseback. To explain that further, when David Wilson set up a new development, they open up their first property and they call it a show home. They set it up all nicely with fixtures and fittings and allow the public to come in and view properties so they can see what they're going to look like should they choose to buy. Now, as an investor, you buy the property and become David Wilson's landlord. They rent it back from you, guaranteeing the rent for 3 years, at which point you can sell the property, you get to keep fixtures and fittings, or you could continue to rent. Again, the fixtures and fittings are yours. So with a discount, this property is worth £345. The discount is £14,995. The rental after 3 years guaranteed is the profit is £59,004. Capital growth estimating at 8% for 3 years would be £93,480, with a projected return therefore after 3 years of £167,482. We really like this property investment idea because David Wilson will raise the prices of the properties in the plot for phase 1, phase 2 and phase 3 anyway, so you're locking in your capital growth, a discount and a rental guarantee all in one. Why do people always rush out to buy their first house and then stop, having realised after 10 years it's the best investment they've ever made? Well, it's fear. They're scared of making mistakes. The lack of knowledge is a really steep learning curve becoming an expert in property investment. There's loads of hassle, or there could be. Leaky taps, tenants ringing up, giving you grief. And then there's the lack of free time. Where are we going to find the time to do the research and stay on top of all this? So what are your options? You could try all this yourself. You could spend time going out and doing the research, working out how to do negotiation yourself, attempting to find a property and market it and stay on top of the portfolio yourself. Or you could even go out and get an education. one of these so-called seminars that teach you how to get rich, spend £5,000-10,000 on a weekend away, go with a mentor who will teach you how to invest in property. Let me let you into a secret. Someone we work with has done and run courses on behalf of companies like this, and he's been out on weekends away with the clients where they accompany that client to a deal, research the deal, and leave it to them to do the deal themselves. And a great majority of those clients who go on those weekends don't actually follow through with the deal because they're still scared of the whole process. What if there was a company out there that could do all of this hard work for you? That's the research, the negotiation, the finance, the legal, the management, and the tax advice, all for you. And you get on with your life. How much work have you done so far? Let's consider just one deal. Sourcing takes about 30 hours. Negotiation would save you about 20,000. The finance is at least 2,000 saving over the duration of the mortgage. Then there's the legal side. A dedicated lawyer will give you peace of mind, which is priceless. A management company dedicated to maximising your rent, researching and doing all those things we mentioned before, will save you at least £1,000 per year on each property. Then there's the tax. The destruction of wealth is huge if you get the wrong advice for tax. So with a good advisor, you'll save an inordinate amount of money with placing a notional value of £1,000 on this. So this is giving you the peace of mind and freedom to get on with your life. So how do you get started with Midas? Well, first of all, you'll come and see us and we'll do an appraisal and then send you a recommendation based on our research and understanding your goals clearly. We then activate the team and you buy your first property, get your portfolio started. We'll find the tenant and manage for you, and then we'll review every 6 months to make sure you're on track. So what does it all cost? Well, to start with, we offer you a free initial appraisal where we'll sit down with you and go through all your options, consider what you can achieve, and sit down and work out what's your best plan going forwards. And with option 1, we charge 2.5% commission of purchase on exchange for each property, and £1,000 a year to manage your portfolio. So that's to stay with you, to do regular reviews with you, and to keep in touch and check everything's going okay, and to continually check you're on plan. It also includes those financial reviews, those rent reviews, and those portfolio and equity reviews. Then there's option 2, whereas you might decide you want to do things for yourself, and we charge 3% commission on purchase to take advantage of our superior negotiation power, and you take care of everything yourself. So that's option 1 at 2.5% and £1,000 a year, and option 2 at 3%, and you handle everything yourself. We operate an ironclad guarantee, and that is that all our properties sourced will generate positive cash flow. We also don't hold our customers to any commitment on contract. So what do you do whilst your money works for you? Well, you get to spend more time with your loved ones, design a life of choice, and write your own script. And what's fantastic about all of this is we'll hold your hand all the way. This is not for everybody. In fact, this is only for people who really want to make things happen. And in life, there are those that want things to happen, those that make things happen, and those that wonder what happened. We are committed to delivering excellent customer service, and in order to maintain that level of service, we can only serve a small number of customers at any one time. That's because we'll visit you in your home. We'll take all the time you need to make your decision, and we never rush anyone. So we want to make sure we get it right. So take a moment to fill in the form below and book your free appraisal now. We will call you back for an appointment, and we'll also send you that free investment report where we'll send you all of our latest deals. Get filling out the form, and we look forward to speaking to you soon. Have a great day.